Welcome back to Squawk Box. Rick Santelli here with live breaking news. Our December read on housing starts and permits. Expecting up around 1.25 million, a bit less. 1.078 million that's seasonally adjusted and annualized. And that is, well, it's not only sequentially lower, it's definitely a miss. And that's following a slightly revised lower number. That was 1.214 million seasonally adjusted and annualized. Permits, on the other hand, well, they're down sequentially a fairly good amount, but they have a nice jump. 1.326 million, that follows 1.32 million. There was a subtle adjustment. So from the sequential standpoint, it's down just a little bit. Actually, I take that back. It's not down that much. Some of the numbers are a little blurry here, but that isn't bad. So permits better, starts a little bit worse, and we're going to continue, of course, to monitor everything that is housing. We still have S&P Core Logic out, Richmond Fed, and Conference Board Confidence. You know, like many sessions, the treasuries are giving up a little bit, but mostly in a rather tight range. On the other hand, even though equities are lower today, they've been anything but in a tight range. Becky, back to you.
Hey, Rick, thank you so much. For more reaction to the data, let's bring in Steve Liesman and Dana Olick. And Steve, why don't you go first? Just quick things that you're seeing reflecting here.
This is not the most important month of the year for the housing market. It's delayed data. It's a surprise in terms of the amount that it's down. What I'm waiting for and what I really want to hear Dana Olick, the expert, talk about is the sensitivity of the housing market to lower interest rates. This was the first month after the mortgage rates really started to fall. We've gone looking at the conventional 30-year mortgage data that I have about 0.6 down, and you would expect you'd expect some kind of response. However, since the recession, housing's kind of been dancing to its own tune as it recovers very, very slowly from the financial crisis.
Diana, what do you think?
Well, you know, Steve, you're stealing my thunder is what I'm saying. That's what I was going to talk about is the mortgage rates. We were at 5.01% on the 30-year fixed at the beginning of November. We're at 4.46 today, and the big drop did come in December. What's killing me about these numbers today is the single family. You've got to divide out single and multifamily from that big 11% drop month to month. You had single family down 6.7%, multifamily down 22%. Multifamily is more volatile, but to see that single family really drop that much and 10.5% year over year, when you have so much housing demand, you have falling mortgage rates, you have people who are really desperate to buy homes, especially at the entry level. We're just not seeing the builders step up. And we saw that in the big builder earnings. I mean, I know this data is backdated by a couple of months, but in the builder earnings, most of those top guys were saying, look, we're just not seeing the interest for our homes. And that's because new homes come at a price premium.
You know, it's a really interesting conundrum. We talked about it with Warren Buffett yesterday, Steve. He says he doesn't know why. He sees it in his business related to it.
It was the one thing he mentioned. He said everything's fine, but housing's terrible.
Well, he didn't say terrible, but it's off.
He said it was weak.
It's surprising. It's surprisingly weak, given where we are in the recovery, given what you would have anticipated coming back after the steep drop-off in 2008.
There's an awful lot of things going on. On the first hand, if you look at a long-term chart, or say from the recession to today, what you see is a steady incline in housing as we recover from ridiculously low levels from the recession. And by the way, that number is only very poorly correlated with mortgage rates, which have been steady for a long time and now have taken a dip down. That's one thing. You have this whole demographic thing of people your age and younger, Becky, who are less interested in buying homes, more interested in renting.
Not my age.
Under 30, yeah.
Well, that's what I meant, under 30.
But Steve, that's just clever.
That's what I meant, or 35 and younger.
Yeah.
You also have, by the way, Diane, I'm sure will weigh in on this, the student loan issue, which is an issue that has weighed down people. So there are a bunch of sort of, I guess what you call them
But Steve, you talk about that correlation, you know, between interest rates and home builders. Now, the home builder sentiment number, which was not government data, so we've been getting that every month. The most recent home builder sentiment data this month actually jumped up on those lower mortgage rates, with builders expecting to see more demand. So why aren't they putting more holes in the ground? And it's interesting what Warren Buffett said, because I tweeted at Becky, of course. It's that people are just making different choices. Now, I don't know that they're making different choices because they want to or because they have to, because housing affordability is at a decade low. Home prices still rising. We're about to get the Case-Shiller numbers. The gains are shrinking, but they are still very overheated. And even this drop in mortgage rates is not pulling enough people back into the market, certainly not into into the new home market.
One thing very quickly, which is sort of keep the jury out on the housing market till the spring selling season rolls around. I think this should be a decent spring, you know, the economics of people having more jobs, people having higher wages, and rates being lower. It could help, and I think you can't judge it fully until we get the spring selling season.